If let's say there's a 25-year-old who's watching this video, and if you were to advise them to structure their portfolio in terms of asset allocation and how to build their portfolio from scratch, what would you advise them?
So if I were to look at today's circumstances versus what earlier circumstances that I was having, where you could see first 15 years, I could see a lot of crises hitting the market and every time wealth destruction happening. Versus today, the markets and economy of India has become far more stable. You have ups and downs, but they are just temporary cycles. The growth is linear, and still, if you look at it even today, the growth is looking very linear in terms of GDP growth. India has just now become fourth largest GDP nation in the world, and it will overtake or become third largest in few years. So I think today you need to have more exposures to equity than what I was having earlier, because equity is going to give us return more than what you are getting from other instruments. So I think single most advice in terms of portfolio allocation would be, particularly to the young investor, is that have more exposure to equity and have a structured investing. Don't try to think that you can make money in 1 year. It's like cricket, right? I mean, you can't make sixes in each over, but if you survive, you can definitely win.
And when you say having more exposure to equity as far as the youngsters are concerned, so is there like a framework? Is there a number that, okay, 50% or 70% of your total net worth should be parked in equities and then remaining can be in debt? Is there a range that you can think of?
Generally, I mean, it depends on your risk appetite and your financials. How much money you are willing to put as a risk capital. And second is whatever you want to invest in debt is a function of how much liquidity do you need when there are bad times. So I think as long as you are able to put a liquidity aside, which takes care of your some of the emergency expenses, I think everything else you can put in the risk capital depending on your financial capabilities.
There was a rule which I was reading on the internet. It's called as the 100 minus age rule. And what it says is that if I am 26 right now, so 100 minus 26, which is 74, 74% of my portfolio should be in equities and 26% it should be in fixed income, which is like debt mutual funds or corporate bonds, etc. So do you agree with this view or do you have a differing viewpoint?
No, so I completely agree. I think the theme in that principle is that as you grow older, you have a lesser exposure to equity, and when you are young, you have more exposure to equity. Extent to which you want to have it, this rule might not be applicable as a thumb rule, but as a trend, I think this should be followed.
If you learned something new from this video, do share it with your friends and subscribe to this channel so that we can bring you the best content possible. Also, if you want to watch this entire episode, click on the link in the description box and you can go to Kushal Lodha YouTube channel and watch the entire podcast episode. Thank you so much for watching this and have an amazing day.